Welcome one and all to another session of Valuation Basics with Irwin. So my name is Irwin. I am a lecturer for the Singapore Chartered Accountancy Program, and today I would like to give an idea on how we find the cost of equity using the CAPM model. Many, even if you are not taking the same course as what I'm teaching, many would find the basics useful. So let's go without further ado. Now, when it comes to finding the cost of equity, you will commonly hear students saying we need to use CAPM. We need to use CAPM. Now, what exactly is CAPM? In its long form, it stands for the Capital Asset Pricing Model. But that doesn't mean too much. What in essence is this model? This model assumes that an investor's return should be proportional to the risk that he takes. So therefore, if you are a shareholder, the return you expect would depend on, wait for it, the systematic risk. Now we would think risk, but in finance, risk is composed of systematic and unsystematic. Unsystematic risk is ignored within finance, and in line with that tradition, I'm even going to ignore it here. But of course, that's a small joke. Joke aside, actually, unsystematic risk, yes, it is ignored for a specific reason. It will not be covered in today's lecture, but you could go and do your own research to find out why systematic risk is the only risk we watch out for within finance. So basically, shareholders would want a return based on the amount of systematic risk within a firm. And since this idea of systematic risk is so important, it should come at no surprise that it is within the formula below. This is called an equity beta. And the systematic risk of a firm is represented by the equity beta here. Now, this is the CAPM formula. And within this formula, let's see what the variables are. So, this formula proposes that the cost of equity, KE, alright, it is equal to, so let me just take away the border. I now find it a little distracting. So, it is equal to RF, the risk-free rate, plus equity beta, what we mentioned earlier, which is representing systematic risk. So that's equity beta up there. Multiplied by, in the brackets, the return of the market, which is represented by the return of a stock index. For example, the S&P 500, right? Or if Singapore, it would then be the Straits Times Index, the STI. In Japan, it might be the Nikkei 225. So the return of the market, we would find its proxy, or we would use a stock index to estimate it or to find a number. Alright? So that is the return of the market, and you minus off risk-free within. So to recap it again, your cost of equity would be the risk-free rate, alright, plus a certain risk factor, which is your equity beta, your systematic risk, multiplied by the within, RM minus RF. And this will give us an answer for the cost of equity, right? Now, there is an intuitive way to understand this, right? An intuitive way, let's give it a shot. In 1 or 2 minutes, let's try. An investor, when he invests in a company, let's say a listed company, if you ask him, come, invest in me, I'm a listed company. You next ask him, what return would you like so that you would invest in me? Now, the first thing he would say is, do you earn as much as the risk-free rate? If I invest in a government bond with, let's say, the United States of America, that is taken often as risk-free. Do you earn me as much as an American bond? This is the most basic question, isn't it? And of course, you got to say yes. Whatever that bond gives you, 2%, I promise I would surely give you as a listed company as well. Next, I would then ask, okay, you are a listed company. Would you give me what the stock market returns me? After all, I am entering the stock market, right? I'm buying a listed company. I am entering the market. So, will you give me something similar to the return of the market? So, if the market typically returns 11%, will you give me 11? The listed company will say, yes, of course. 11, but remember, I gave you 2% earlier. I promised you already 2%. So, to just get the market 11, don't mind I minus off the 2% earlier, right? We can't double count the 2%. So now, intuitively, the listed company is telling us, you can get the same return as the market. Your final question will be though, yes, I can get the same return as the market, but, are you riskier than the market or less risky than the market? And this is our dear beta here. The question, are you riskier than the market or less risky than the market? And the company may tell you, alright, I'll be honest, I am riskier than the market. Okay, the area that I'm in, I'm riskier, and therefore my beta is 1.4. Alright, now, since the company is riskier than the market, whatever the market returns, you would then add a multiple there to make the return even bigger. Why? Because if you are riskier than the market, I would expect a return higher than the market, right? So here was where we were considering the market, and I'm going to multiply it by 1.4. It's going to be a bigger amount, and it makes sense. The more risk I take, if you are riskier than the market, you have to return me more than the market. Intuitively, people, this is the bare bones of what CAPM is proposing. How does it work in a question? Let's quickly go down to a question here. So Paradigm Co., a cybersecurity firm, is listed on the Nasdaq exchange. The typical return on the Nasdaq is 12%. So I have my return on market. The US Treasury bill yields are currently at 1.5. Now, with this, it's easier to look at the variables. Risk-free, it refers to government bonds. And of course, we mean stable governments, okay, of developed countries. Risk-free, like here, if they give us the US bond yield, this works, 1.5%. Thank you very much. This is my risk-free. Assume that Paradigm has an equity beta of 1.3, therefore calculate its cost of equity. Now, this is so easy. Let's just put the working in. So, my cost of equity is your risk-free plus beta RM minus RF. So, my RF, risk-free, is 1.5%. My beta is 1.3. Return on market is 12%. Minus my risk-free, 1.5. Okay, let me take out my calculator. 1.5 plus 1.3, bracket 12 minus 1.5. Answer. What do I expect as an investor? I expect to earn a return of 15.15%. Why? Because your systematic risk, your equity beta, it's higher than the market. It's relatively high. Although equity beta could even go up to 2. Alright, 2.5. Those are extremely risky companies, of course. Here, if you are 1.3, you are considered a bit above the market because, let me just add in a small point here. The beta of 1, this benchmark represents the market. So therefore, anything above 1, you are more risky. And obviously then, anything below 1, you are less risky. So example, if your beta is 0.8, less risky. If your beta, like the question, is 1.3, you are more risky. And from there, we then calculate the cost of equity or what shareholders expect. Okay? One last point to add in is, sometimes your question might just tell you the equity risk premium. Alright? When they say that to you, they are actually calculating RM minus RF, which in our case, if I want to ask for paradigm, what is the equity risk premium, it would then be 10.5%. Why? RM 12, RF 1.5, minus off the two percentages against each other, you get 10.5. That is the equity risk premium. Do watch out for it. When it comes out in the exams, they are helping you out and they are saying, hey, I'm giving you the answer to the number within this bracket. That's all. Just fill it in with 10.5%. Okay? So CAPM, straightforward. What else can we learn about CAPM? Ooh, look at this. Look at this formula. Now, let's not get distracted nor overwhelmed by it. It's much simpler, okay? Alright, than it looks. So, equity beta, as we said earlier, it represents systematic risk. However, systematic risk has two components. Alright, systematic risk has two components. They are business risk and financial risk. In simple terms, business risk is just the risk of your business model. Some business models are just more risky than others. For example, a developer of luxury condominiums would have a totally different business risk from your good old supermarket downstairs. Right? A supermarket, the model is in good times, in bad times, people will come, they will buy my produce. But for a luxury condominium developer, in good times, you boom. In bad times, you are in trouble. So different business models have different risks. That is your business risk. It is part of systematic risk. And also part of systematic risk is financial risk. Now this is our gearing. And this is how much debt we take. Okay? And I think that is quite logical. The more debt you take, the riskier you are. I think that doesn't require any explanation. So, question. What if we just desire to examine the business risk of a firm? So, we are saying systematic risk has both business and financial risk within it. What if I do not want the financial risk? I just want the business risk. If you really desire that, you do not want equity beta, you want another beta. It is called asset beta. You will want the asset beta of the firm. Now, asset beta is represented by beta with an A below, as you see here. Asset beta. My good old equity beta is here. Now, we can just focus on this portion of the formula. Why? Because the other side of it involves debt beta. Now, debt beta in our syllabus, and in many syllabuses actually, is typically assumed to be 0. And people, if I assume this to be 0, whatever this is, let's just call it Z. Whatever this works out to be, multiplied by 0 equals 0. In other words, I now have the license to ignore this part of the formula. Okay? So debt beta, we usually assume it is 0. Is it 0 in real life? No, it is not. But in our syllabus, we assume it to be so. Alright? So no complaints about that. Now, we then focus here. Alright, what is VE and what is VD and what is that T inside? Now VE is the market value of equity. VD, market value of debt. T, your percentage rate of tax itself. So what this formula is telling us is, if you really just want the business risk, I put as BR, okay? You just want the business risk, asset beta. Sure, all you need to do, get the total risk, the total systematic risk here, represented by beta equity, churn it together with this fella. This fella actually represents financial risk, okay? So churn it together and pop, comes out only business risk at the end of it. Okay? So how do we do it in a question? And of course, maybe before we even look at the question, why would I ever need to do this? Like, why would I ever want to isolate the business risk? Right? Don't I just need the total risk? Let's find out when would we ever, in Scaq Bg, in this module, when would we ever need to isolate the business risk of a venture? Let's go. Now, Arcadia Games, the maker of the hit game Four Nights, have you played that before? I heard it's quite a hit, has an existing equity beta of 1.3. Its debt to equity ratio stands at 2.5. Now, in here, I already have my beta equity, they gave it to me, and I have my market value of equity and market value of debt as a ratio, 2.5. Now, 2.5. Now, to make sure you do not get confused, right, let me follow the way they presented the ratio. So basically, market value of debt is to market value of equity will be 2.5 is to 1. Okay? Arcadia is considering an expansion into digital music as an opportunity has emerged. Question. The CEO wonders if Arcadia's current equity beta can be used in evaluating the expansion. Expansion into what? Reminder, expansion into digital music. Now, what is the problem here? The problem here, people, is the current equity beta. It has financial risk and it has business risk. But what is the business risk within? Arcadia specializes obviously in gaming. That is the business model. Digital music, is that the same business model? No. It is a different business model altogether. Alright? So, I will have a need to change my business risk. So, the business risk in Arcadia's equity beta is not relevant to the music industry. I need to alter the business risk to suit the music industry so as to have an accurate set of calculations. And it makes sense, people. If you want to find the cost of equity, if you want to find the beta, then the beta itself should be covering the relevant business risk of the music industry. So, problem, my current equity beta only captures gaming. It doesn't really have music at all. My financial risk, they did tell you your financial risk is 2.5 is to 1. That is your debt is to equity ratio. Now, how do I alter my business risk? That is the key now. So let's move on. We now know this guy, the gaming business risk, it's not relevant. I need to get him out of that. And I need to put in a correct business risk. So, since my equity beta is not applicable, Arcadia, intelligently enough, has extracted the following information of a listed music firm, Spotify. Now, Spotify has an equity beta of 1.4, debt to equity ratio of 2, risk-free rate 3%, equity risk premium 5%, tax rate 20%. You are flooded with many numbers. Now, how do we use them to find the correct cost of equity for the project? So number one, in all ventures like this, we need to get published data, which the question gives us, of either an industry average, like the music industry average, what is the risk for the music industry, or we're going to use a company within the industry, and from this company, we are going to do a surgical extraction. Now, what do I mean by a surgical extraction? People, I have the equity beta of Spotify. What is within this equity beta? So let me just step it out. What is within? Its equity beta comprises of its own financial risk and it comprises of its business risk. I need to surgically extract this because this business risk is for the music industry and I want this business risk. I must find a way to do like a surgery, you know. I'm going to take out the business risk from Spotify's equity beta, and later you're going to see me do like a transplant. I'm going to transplant it into Arcadia to replace the gaming one. Okay, so how do we do it? First, alright, let's find the business risk itself of the music industry. Let's extract the business risk of the music industry from Spotify. What is the business risk again? The business risk again is your beta asset or your asset beta. So, how do I surgically take it out of Spotify? Easy, people. This is your operating theatre and the doctor is waiting. The doctor is here. Right? Remember, this is at 0, so this is irrelevant. That beta is irrelevant. We're going to ignore that. So, what I'm going to do, I'm going to lay out Spotify on the operating theatre. Okay? I'm going to lay him out here. What is the value of his equity? We can just follow the ratio here. Debt is to equity, 2 is to 1, right? You could just use this as the value. Actually, they do want the ratio instead of the specific amount actually. It's the ratio that is important. Alright? So you can just use it. Value of equity is 1. Divide by value of equity, 1. Now let's move down a little so I do have a bit more space. So, value of debt, according to the ratio is 2. 1 minus T, 20% is your tax. Alright? 20% is your tax. And then the next line is the equity beta of Spotify. So, tax was 20%. Equity beta of Spotify 1.4. So, I'm going to put 1.4 here. And now, the doctor is working. He's going to give us the beta asset. Oh, asset beta. The business risk. So, we are going to surgically extract the business risk from Spotify. I lay his whole body here and I say, tell me your business risk. So you work it out. 1 divide by 1 plus 2 bracket 1 minus 20%. So you work out the bottom first. Alright. So you would get times 1.4. Your beta asset will be 0.5385. Okay. Congratulations, people. This is a milestone. It is worth typing out some stuff. This is the business risk within the music industry. So if you ask, what is the business risk? Great, I have the business risk already. Now, people, what I'm going to do is I am going to transplant this business risk into Arcadia. So what I'm going to do, is here they say re-gear to add in debt to find the beta equity that reflects Arcadia's financial gearing. So Arcadia, what I'm going to do now, I'm going to say Arcadia's business risk. Alright, I put as BR. I have managed to find the risk of the music industry. The beta asset therein is 0.5. Sorry, my memory is bad. 5385. Okay. Okay? So I've gotten it. Now, in order to get the total risk, I need to put in the financial risk as well, which is simply my debt to equity ratio, which for Arcadia, Arcadia's financial risk, what is it? Let's remind ourselves. Arcadia has a debt to equity ratio of 2.5, which means, people, 2.5 is to 1. Now, we are going to do a Frankenstein operation. I am going to now merge the two of them together, and I will get my beta equity, also known as my total systematic risk. Okay, I'm going to put these two components together like a Frankenstein, put it together, and I'm going to get my beta equity. So, the operating theatre is open and your doctor is waiting. So, let's place in the parts. Beta asset, I know my beta asset is 0.5385 equal to, now lay out his body. What is the value of equity? 1. What is the value of equity again? 1. What is the value of debt? 2.5. Yeah, there is a ratio. What is your tax? 1 minus 20%. Now, in here stands our dear beta equity. I now have to solve the equation and find what beta equity equals to. So give me some time for that. Alright. So, with a little bit of mathematics, you would find your beta equity is 1.6155. Now this, another milestone worth typing out. This covers business risk of the music industry and financial risk of Arcadia. This is the correct risks, or this is the correct risk measure, okay? Alright, so this equity beta is the correct risk measure that we're going to use. Its components are accurate. We now can do the CAPM formula. Use the relevant beta equity that you found, 1.6155, to find the cost of equity. So here, we go back to CAPM, right? Cost of equity equal risk-free rate plus beta equity, RM minus RF. What are the numbers again? So, I have the risk-free rate of 3%. Equity risk premium. Remember, what is equity risk premium? RM minus RF. Okay, we are done. So, people, my risk-free rate is 3%. RM minus RF is 5%. You just put it like that. Remember, equity risk premium is the two combined, right? And throw in your lovely equity beta, 1.6155. What is your cost of equity for expanding into the music industry? Let's work it out. Answer, 11.08%. Done. Alright, people. So using the numbers within the question, we have found what we would do if a company changes its business model. When it changes its business model, the business risk changes. When the business risk changes, you must find the correct business risk to put it in. So what did we do? We went to Spotify and say, Spotify, you contain the business risk that I'm looking for. Right? I will surgically extract this via the formula And the business risk of the music industry, beta asset. Now that I have the business risk, Frankenstein operation, I will combine it, the new business risk of the music industry, with its own personal financial risk, Arcadia's financial risk, merge them, and you will get your total risk measure, beta equity 1.6155. You are now free to use your CAPM and calculate using that beta the cost of equity that is relevant for this evaluation. Folks, this is what we do in SCA. Now, before I end off, a common mistake in SCA is to think that CAPM gives us the cost of capital. It does not. Remember, CAPM is the cost of equity. The cost of capital is actually combining equity and debt, the two costs together, commonly known as weighted average cost of capital, WACC. Separate thing altogether. CAPM is just the cost of equity. Alright? So, I hope you have learned much. Feel free to pause, rewatch this video, and watch my other videos so that you can pick up the basics for valuation. If you wish to connect with me on LinkedIn, drop me a message there, or feel free to write to me on my personal email here. So thank you very much once again, everybody, and I will see you in the next video. Cheers, guys!